When the 20th century was young, Henry Ford summed up the attitude toward choice by saying people could buy one of his cars in any color they wanted as long as it was black. But times and tastes change very quickly. Today, as we approach the 21st century, choice and change have become the dominant characteristics of our society. Virtually every product in every industry offers a variety of choices to appeal to the public's changing tastes and needs. When the insurance industry followed suit, the Prudential became a leader in providing choices. Now, the Prudential is celebrating a product that represents choice at its best. VAL, Variable Appreciable Life, began its 11th year in 1995, and the future of choice looks better than ever. From its beginning, Variable Appreciable Life has been viewed by the Prudential and by the industry as an innovative and exciting product, a viewpoint which our clients obviously shared since VAL quickly became the Prudential's most successful product. This video is the first in a series about VAL. In this and subsequent programs, we hope to build on the excitement that launched VAL 10 years ago, show you how the significant features of VAL work, and see how those features mean benefits which can help your clients toward their insurance and financial objectives. For example, in this program, we're going to review some of the VAL basics to help you understand and use this contract most effectively. You'll see how the product has evolved over time and look at the most recent enhancements and modifications to our current practices, which are designed to keep VAL an attractive and sound product. And we have 3 brief role plays to demonstrate specifically how to explain the ultimate premium change to clients. Now, while VAL is still a relatively young product, it already has an impressive history. In the late 70s, high interest rates led to the growth of universal life products. But as interest rates began to decline, many consumers began to look for a different way to safeguard their financial future. They still wanted the security of a permanent life insurance, but they wanted it in a product that offers individuals the opportunity to react to their changing financial needs and obligations, as well as the changing economic climate. VAL combines some of the best features of traditional whole life, universal life, and variable life, offering choices that work for a wide range of client needs. For example, premium flexibility is one of VAL's most important features. VAL clients can select a premium payment schedule that fits their current budget and adjust payments as their situations change. Or they can choose a higher level premium option and be billed for the same premium for the life of the contract. In either case, clients can make additional payments to help their policy values grow. And each client decides how his or her premium dollars, after certain deductions of course, should be allocated among investment options. Clients essentially customize the investment portion of their policy to take into account their personal levels of risk tolerance, as well as their needs and any external changing economic conditions. Clients can also take advantage of VAL's withdrawal and loan privileges, which give them access to the contract funds they have built up. Periodic reviews of these and other VAL features ensure you'll be able to give your clients the information they need as they make the financial choices that are right for them. Full details about all of VAL's features are contained in updated marketing and training materials created as part of VAL's 10th anniversary promotion. One of the aspects of VAL to which you should pay special attention is the way the product has evolved. Prudential continually refines VAL to keep it fresh, competitive, and financially solid. When VAL was first introduced, the series fund portfolio of investment options contained only 5 choices. Subsequently, several investment options, including the real property account, were added to the Pruco Life versions of VAL. When we introduced VAL 86, we adopted our current practice of no longer deducting sales charges once we had received 5 annual premiums. This practice was applied to in-force policies as well as to new business. It effectively reduced the price of the policy. The present product, VAL 88, included the zero coupon bond options and is issued by Prudential instead of Pruco Life. As you can see, VAL is a dynamic product. The Prudential is constantly adding portfolios to the series fund to give our clients more investment diversity. Regardless of what changes are made to the series fund or to other aspects of VAL, our goal is the same. to provide value to our clients, and to manage the business to make sure the Prudential is here in 100 years to make good on our promises. In keeping with this goal, we're introducing several new features to the product effective May 1995. First, we are adding 2 more investment options to the contract, a growth stock portfolio and a small cap stock portfolio. The growth stock portfolio is complementary to the common stock portfolio, which is managed on a value strategy. A small capitalization stock portfolio will provide clients with the opportunity to invest in smaller companies and will be based on the S&P Small Cap 600 Index. The other new feature of VAL is a revision to the current process we use for the ultimate premium change calculation. A distinctive feature of VAL's design is the modified premium structure and how it supports the guarantee against lapse. The modified premium has always been an attractive feature because it means clients can purchase about 50% more permanent insurance for each dollar of their initial premium than could be bought under a comparable level premium policy. When a VAL policy is sold, we must explain to clients that we charge a relatively low initial premium, but that we reserve the right to charge a higher premium later. The time for changing to a higher premium is the policy anniversary, following age 65, or the 7th policy anniversary, whichever is later. For the Pruco Life VALs, it is age 65 or the 10th policy anniversary, whichever is later. This is called the premium change date. In 1994, with the first VAL contracts beginning to reach their premium change date, we implemented a process to determine a new scheduled premium which would guarantee the death benefit under the contract and would, for many clients, be lower than the maximum scheduled premium found in the contract. This lower premium could be as low as the initial scheduled premium. For contracts reaching their premium change date on or after May 1st, 1996, we will only guarantee the lower premium for 1 year at a time. While we will only give an annual guarantee, practically speaking, we do not expect to actually change the premium. Retaining the flexibility to change it allows us to maintain smaller but still adequate and conservative reserves. The modified process will be reflected in the May 1st, 1995 prospectus and will apply to all VAL contracts which reach their premium change date on or after May 1st, 1996. The current process will continue to apply to those contracts which reach their premium change date prior to May 1st, 1996. At this time, it's necessary to tie in another aspect of VAL's premium flexibility, the way we monitor premium payments. To check whether we have received all due scheduled premiums on a VAL policy, we have a device called the premium account. This allows us to check each month and compare all scheduled premiums due to date against all premiums actually paid. For this purpose, we consider a withdrawal as a negative premium payment. For example, if a client paid his or her $1,000 scheduled premium when due, but then withdrew $1,000 the next day, the premium has, in effect, not been paid. For the death benefit guarantee to be in effect, the premium account balance must be at least 0. That is, the premiums paid accumulated at 4% must at least equal the scheduled premiums due, also accumulated at 4%. If those two match exactly, the premium account balance is 0. If the paid side exceeds the due side, there is a positive balance, and of course, if the due side exceeds the paid side, there is a negative balance. A client can always bring his or her premium account up to 0 by paying any missing premiums plus 4% interest. Incidentally, the 4% interest is not lost to the policy owner, but remains in the contract fund. Now, let's see how the premium account operates in the premium change process. The whole purpose of the premium change process is to determine a new premium for the premium account. The guarantee that the contract will not lapse will be based on the payment of the new, lower premium when due. We intend to update the premium account by the lower amount, but reserve the right to change it. Payment of the lower premium net of withdrawal will guarantee the contract a year at a time. Let's look at an example using an illustration from the May 1995 prospectus. This is an illustration for a male, age 35, preferred, $100,000 VAL B variable death benefit in a state using a 2% state premium tax. The illustration does not include waiver of premium. The initial scheduled premium is $894.06, and in footnote 3 of the illustration, we show what the recalculated premiums would be given the various assumptions on growth rates. The maximum ultimate premium in this case is $4,726.61, as shown in the footnote, for a gross rate of 0%. This means that if this client pays his premiums from age 35 to 65 and earns 0% gross, then his premium will increase to the maximum, pretty much as he would have expected. For earnings of 4%, the contract fund has grown such that there is a small reduction in the scheduled premium. The footnote, based on an assumed growth rate of 8% gross, shows that the recalculated maximum premium is about $3,260, but the second lower premium is $894.06. This is the same as the initial premium and again consistent with what you would expect. If the theoretical scenario laid out in this illustration actually came to pass, then this client would get a bill for $894.06. Payment of that premium would guarantee that his policy could not lapse due to poor investment performance until the next anniversary. Of course, this is provided he did not make any withdrawals that year. We anticipate billing this client for this same amount each year, and we don't expect that it will change. In other words, if this client pays scheduled premiums when due, takes no withdrawals, and has earned between 6% and 7% net as of the premium change date, he will see his maximum premium reduced and will bill at or very close to his initial premium. Whether it is to explain the addition of new portfolios to the series fund or to explain the premium change date, this latest stage in the evolution of VAL gives you two new opportunities for discussion with both new and in-force clients. Choice and change. With many consumer products, they can reflect merely passing fancies. But to consumers with sophisticated tastes and needs, they represent flexibility, versatility, and in economic terms, affordability. These are the principles that will continue to make VAL and you successful. Pat Edwards is making a sales call with a potential first-time Prudential client, Ellen March. Pat has conducted a thorough needs analysis and gathered information about Ellen that indicates a VAL policy is the most suitable option to meet her financial objectives. Using illustrations she has customized for Ellen, Pat has already gone over many of the features of VAL and is about to explain the scheduled premium amounts and the premium change date.
There are a couple of important features about VAL that I'd like to go over with you, Ellen. They concern the contract guarantees. As we had discussed, the initial scheduled premium for your VAL policy is lower than the premium would be for a regular whole life policy. If you pay these scheduled premiums when they are due and don't make any withdrawals, then the policy is guaranteed not to lapse due to poor investment results.
Yes, I remember you saying that. And I think you said there's a grace period, too. What was that?
You have 61 days after each due date to pay the scheduled premium. The initial scheduled premium continues up to age 65. Actually, it's the policy anniversary following your 65th birthday. At that point, the premium can go up.
What can it go up to?
Well, the most the premium can go up is shown here on this illustration. It will also be shown on your policy and is called the ultimate premium. Your ultimate premium is $3,800.
$3,800? That's quite a bit higher than $780. But you said it can go up. Does that mean it might not go up?
That's right. This is the maximum your premium could be. The actual scheduled premium will depend on a number of considerations. One, your policy's value at the premium change date. We don't know how the investments you've chosen are going to perform. Two, we also don't know how much premium you're going to pay in over the next 30 years or so, or what withdrawals you might make. And three, we can't be sure exactly what our charges for things like mortality and expenses will be. All of these things will influence your policy value. So when we get to the premium change date, we'll look at your policy at that particular point in time and we'll calculate a new premium for you. The new premium can never be more than this maximum shown here.
Now, if this is the most it could be, what's the least?
Good question, Ellen. It cannot be less than the initial premium.
So if I understand correctly, the premium after age 65 can't be less than the initial premium, but can't be more than the ultimate premium.
That's right.
Okay, according to this, my present premium would be $780 a year. What would have to happen so it wouldn't change?
Okay, let's assume you pay all your premiums when they're due, don't make any withdrawals, and earn somewhere in the neighborhood of 6 or 7% net. Let's also assume our current level of charges stays the same. In that case, we'll send you a bill which will show two premiums, a new maximum scheduled premium and a second lower one. The lower premium would be at or near the present $780 a year.
And that $780 will guarantee my policy?
Payment of that premium will guarantee that your policy cannot lapse due to poor investment results until the next policy anniversary. We reserve the right to change that premium, but it can never be more than the new maximum premium shown on your bill. We don't anticipate changing your premium, and we would only consider changes for a whole class of policies, not just yours as an individual.
I think I understand. What else do I need to know?
Today is May 18th, 1996. Bob is a 67-year-old preferred issue holder of a Prudential $100,000 Val B variable death benefit contract, which he took out when he was 60. Prudential rep Hal Carpenter has been servicing Bob's insurance needs for about 6 years. Although he did not sell Bob the Val policy originally, he is here today because Bob's policy has reached its premium change date.
Bob, I know that ever since I took over your policy, we've gotten together once a year just to go over your annual statements. I don't know if you remember, but last year when I was here, I said your premium was due to change this year. Do you remember that?
Not really.
Well, on this anniversary, you will have reached what your contract calls the premium change date. The bill you're going to be getting will look a little different. I thought this would be a good opportunity to go over the premium change in a little more detail so you'll understand the bill when it arrives. Is that okay?
Sure.
Let's just look at your policy. Right now, for your $100,000 policy, the scheduled premium, that's the premium we've been billing you, has been $315 a month. In the policy, it said that the premium could go as high as $492. See? Right here, $492.
Does this mean you're getting ready to charge me $492?
Not at all. When you took out the policy, we were able to charge you the low premium, the $315, and guarantee the policy by reserving the right to change the premium to $492 if we had to at a future date.
And
I've got good news for you. It won't be $492. How much we're actually going to have to charge you depends on how well your contract's done. Your contract fund right now, see this amount here? Is just over $20,000, which is pretty good. In fact, I did a little research, and over the last 7 years, you've paid all your premiums when due. According to this statement, you've earned on average 8.9% on your money. So on your premium change date, we looked at your policy with those facts in mind, and I've come up with 2 new premiums.
2?
Next month on your new bill, the $492 maximum will be gone. It no longer applies. Your new maximum premium from now on would be $458. And because of your contract's performance, your monthly premium will be $315.
That's a relief. Why do I even need to go through this premium change date thing then if it doesn't change?
Because it does change for some people. When we quote you this new maximum premium, basically we have to take into account several things. We have no idea how your investments are going to perform until the policy matures, or what sort of charges we're going to have to make, what mortality rates are going to be, or what our expenses are going to be in that same time period. Being an insurance company, we have to make some conservative estimates on what all that might be, not just for you, but for all of our policyholders. We guarantee that from now on we could never raise you more than this maximum amount to keep your policy in force. But frankly, since we think that's going to be more than is needed to keep your policy in force, given any reasonable set of circumstances, we've determined the lower amount should be sufficient. So we will bill you at the $315 monthly premium.
And if I pay that amount each month?
We guarantee your policy won't lapse due to poor investment performance prior to the next anniversary.
You said my contract has been earning about 8.9% on average. What if my average goes down? Is that when I'd start paying that higher amount?
The premium's not figured simply on the performance of your investments. There would have to be many years of negative returns across the whole spectrum of investments for us to consider changing everybody's premium, not just yours. For the type of policy you have, we reserve the right to change the premium if we needed to. Let's say all investment results within the series fund as a whole went very badly for a number of years. Then it's possible we'd consider charging more than $315. But even if we did, it could never go beyond your new maximum, the $458, at any future time.
So what you're saying is, in my case, it isn't necessary to change now, right?
Right. While it could change, we do not expect that it will.
What if I paid less than what you're asking me to?
Paying that premium guarantees that your contract cannot lapse due to poor investment performance on a year-by-year basis. If you don't pay that premium, but you don't make any withdrawals either, the policy still stays in force provided there's enough money in the contract fund. Right now, you're fine. It's possible that if you earn favorable investment results over the coming years and don't pay any more premiums, your policy would stay in force. But when you do that, you're relying on investment performance to keep your policy in force. In that case, your individual investment performance is a consideration, and your policy could lapse unless you made up the missing premiums and brought your fund back up to an acceptable level.
I get it. How long before I see the first new statement?
It's September 1995. Bob is a 67-year-old preferred issue holder of a $100,000 Prudential Val B variable death benefit contract purchased in 1988 when he was 60. Prudential agent Hal Carpenter has been servicing Bob's insurance needs for about 6 years. Although he did not sell Bob the Val policy originally, he is here today because Bob's policy has reached its premium change date.
As usual, Bob, I just wanted to keep in touch with you on your anniversary date. The last time we met, I mentioned your policy would be due to change this year. You're going to get a new premium bill next month. Your present premium is $315 a month, but on your policy it says that once you've had the policy 7 years or reached age 65, whichever is later, it could go up as much as $492.
Oh no. You mean it's going to go up to $492?
Not at all. The good news is your premium's not going up. Your premium change date came up, we looked at your account and estimated a new premium. But because your policy has done very well, your premium hasn't changed. It will stay $315 a month. Continue to pay us $315 a month, and your policy is guaranteed not to lapse, regardless of investment results.
Are you going to change it somewhere down the line?
We will never change your $315 premium. If you don't pay it, your policy could lapse if the contract fund goes below a certain level. But as long as you pay your premium and take no withdrawals, your premium isn't going to change, and your policy will not lapse.
Note that although the situation is very similar to the second role play, there are two important differences because the premium change date occurred in 1995. First, there is only one premium quoted, and second, there is no year-to-year guarantee.